If you've been on YouTube lately, you've probably heard messages like RMD fears are way overblown or Roth conversions are the new annuity pitch, and the vast majority of people don't need them. The argument goes something like this. Only a really small portion of retirees are actually hurt by required minimum distributions. So the rest of us shouldn't really even worry about it. In this video today, I want to take some of the ideas in some of these other videos further and see if some of these RMD claims and these concerns are actually overblown and really analyze if this is true. I don't know if anyone else notices this, but retirement planning YouTube loves its grand statements. A few years ago, this corner of YouTube was flooded with Roth conversions are the holy grail type videos. Some creators were practically encouraging people to convert everything in sight, massive Roth conversions over just a few years. But lately, especially after the so-called one big beautiful bill passed, we watched the pendulum swing the other way. Now the new trend is Roth conversions are overrated. RMDs aren't a big deal anymore. And look, as someone who's been part of this space for a while, I think both extremes are frankly a bit idiotic. Sure, they get clicks, people love a simple, absolute answer, but they don't lead to good planning. My concern is that these black and white takes are convincing a lot of viewers to make black and white decisions in very gray areas. And these have real tax consequences. So I went through several of these RMDs are overblown videos, pulled their main arguments, and I want to put some actual data behind them. Now, before we get into some of those arguments, let's talk about the big RMD fear in general. On the screen, you can see a side-by-side example for a couple before and after RMDs kick in. Remember, RMD stands for required minimum distribution. Once you reach a certain age, currently 73 or 75 depending on your birth year, you're forced to withdraw a minimum amount from your tax-deferred accounts like traditional IRAs and 401ks. In tax planning, forced withdrawals are almost always a bad thing because they take away your control. And when you lose control, you usually end up paying higher taxes than you otherwise would. So before RMDs, here's what this client situation looks like. Total retirement income was just under $100,000, and this more than met all of this client's spending needs. You can see because of this, taxes were extremely low at less than $500 a year. Pretty great, right? When they control the timing of their withdrawals, their tax bill is next to nothing. But now watch what happens the following year when RMDs start. We'll hold everything else constant, no inflation bump to Social Security, same dividends, same pension. The only thing we're going to change here is the forced IRA withdrawal. Instead of taking out just $15,000, they're required to pull nearly $80,000 based on the size of their account and the RMD formula. Their tax bill jumps from less than $500 to more than $12,000. Now, paying $12,000 in taxes isn't catastrophic, but it's certainly a totally different situation. To make this fear even more real, many retirees won't find their first RMD all that painful, but over time, something happens that we refer to as RMD creep. Here's what this means. RMDs tend to grow throughout retirement for two key reasons. First, the starting withdrawal rate that you're required to take at age 73 or 75 is actually pretty modest. It's roughly 3.5% to 4%. So many retirees, their IRA or 401k balance will continue to grow even after taking these required withdrawals. Second, the RMD formula itself forces a higher percentage every year as you age. So your required withdrawal rate climbs even if your portfolio doesn't. These two forces, growth in the account and then growth in that withdrawal rate, combine to create a steady upward push that we call RMD creep. On the screen, you'll see an example of this. Each line represents a different annual RMD based on a portfolio, all starting at the same place and earning about 6% per year with a little bit of normal market volatility. Notice how these RMD withdrawals increase every single year, at least until you reach those later ages in life. So this is part of what drives this fear. If RMDs are a problem now, they will become that much bigger of a problem later in retirement. Now, let's zoom out for a second. Not all retirement problems are created equal, of course. There are bad problems like running out of money. That's the kind of risk that could really derail your entire retirement. And then there are what people call good problems, like having RMDs that push you into higher brackets and obviously higher taxes. This type of problem means you've saved well, your investments did their job, and you now have more income than you need. And yes, in the grand scheme, good problems are a good place to be. But here's the catch. A good problem is still a problem. If you've worked hard, saved diligently, and built a strong portfolio, you've also earned the right to care about efficiency. You shouldn't shrug off and say, oh, well, I guess I'll just pay more in tax because I can. I mean, sure, you can take that approach. And yes, good problems are better than bad problems, but I'm in the camp that we should aim to fix as many problems as we can. Now, let's move into a few cases other advisors make for why you don't need to worry about RMDs. Case number one, deductions and exemptions have grown significantly. The argument is that because the standard deduction is so much larger today than it was, let's say, in 2017, less of your income and ultimately less of your RMD will actually be taxed. I saw this example in another video. They compared 2017 to today and showed how the current standard deduction is more than double what it used to be. And on the surface, this sounds like a huge deal. Another 23,000 or so of an RMD sheltered from tax. Well, who wouldn't like that? But here's the issue. There's a lot of fudging with the numbers happening inside of this comparison. First, it's comparing 2017 to now without adjusting for inflation. Once you make that correction, the gap shrinks considerably. Most of the rest of the difference between these two numbers, the part that makes today's deduction look so generous, comes from something brand new, the senior bonus deduction. That's roughly $12,000 boost for a married retiree. But it's also temporary, only around for 4 years under current tax law. So yes, today's deductions help a bit, but they're certainly not the game changer that some videos make them out to be. Once that bonus expires, the difference is quite marginal overall, and certainly not enough to erase all RMD fears. Next, let's talk about the change that came with the Secure Act in 2020. The RMD formula appeared to become significantly more favorable overall. On the screen, you can see the old RMD withdrawal table compared to what is now the new RMD withdrawal table. At every age, the new table requires a little bit less, roughly 0.2 to 0.5% less each year. These are small differences on the surface, but obviously over a multi-decade retirement, those small differences start to add up. And along with that, we've also seen the RMD starting age move back from 70.5 to 72, and now 73 or even 75, depending on your birth year. Again, this all seems really helpful, and I bet nearly everyone watching this video is just nodding their head along that these changes indeed make RMDs less of a concern. But what if we actually run a test? What if we put this to data? I'm going to use the old RMD tables and compare it to the new RMD tables while also comparing different starting ages, 70.5, where the starting age used to be, and now at, let's say, 73. We're also going to be using historical returns of a 50-50 stock bond portfolio for our comparison. You can follow along on this table through age 90, and we see something pretty surprising here. Here's the good news. The new method for delaying RMD ultimately helps this retiree end up with a larger portfolio because it delays these forced withdrawals, allowing for more compounding. But look at the cumulative RMDs one is forced to take. They're actually forced to take more in RMDs and do so in a shorter period of time underneath the new rules. So we see that it's not clear at all that these new RMDs tables fix any of the RMD problem. Remember, we live in a progressive tax system. So if you're forced to take higher withdrawals in a shorter period of time, you're no doubt paying higher taxes than you otherwise would underneath the old rules. So we see that it's not clear at all that these new RMD tables fix any of the RMD problem. In fact, a case could be made it's exacerbated because it allows for a larger RMD creep overall. Live long enough, and actually the new tables can create a bigger RMD problem. The updated RMD rules only help if you live a shorter life. Quick aside before we move on, since joining Merit, our team has been able to expand capacity and lower our minimums for viewers of this channel. If you're interested in exploring working with our team, use the link or phone number in the description below and mention that you've been watching our YouTube channel. If you call Merit's general line or fill out a general form, you might be paired with a different advisor who may or may not share our exact planning philosophy. They also may charge higher fees. Using this link ensures you connect directly with our team. Then we have what I'd call the biggest adjustment from the One Big Beautiful Bill, the extension of the Tax Cuts and Jobs Act tax brackets. This one doesn't change the size of your RMD and all, but it does change how your RMD is taxed. Without this extension, we were heading towards a reversion to the old rates, where the 12% bracket jumps to 15, 22 to 25, and so on. Now, the lower tax rates we've been used to have been extended. For most retirees, this is the most meaningful change that is affecting RMD and Roth conversion planning, without a doubt. Without this change, you can convert at lower rates today and avoid RMDs taxed at higher rates in the future. Now, it's not quite as simple. Then finally, we get to, in my opinion, one of the shakiest arguments of all. I've seen a lot of channels say something like, RMD fears are overblown because they only affect wealthy retirees, and percentage-wise, that's such a small group of people. As if somehow this means we shouldn't even be talking about this topic. Now, sure, it's true that someone with $100,000 or less saved for retirement doesn't have to worry about RMDs. That's probably around, I don't know, based on the data, 30% of retirees. It's also true that these folk are probably not in the retirement planning viewership pool on YouTube because by definition, there isn't that much to plan for. I don't mean this in a negative way. But someone with only $100,000 saved for retirement really doesn't have that many options or, frankly, decisions to make. Even beyond this, there are enough Americans retired where a small percentage of people can actually add up to quite a few people on an absolute basis. To imply that no one needs to worry about RMDs because maybe only a small number of people need to worry about RMDs is a misguided conclusion. Let me throw some counterpoints at you to further muddy the waters. JP Morgan recently did a study that found 80% of retirees don't withdraw from their tax-deferred accounts before RMD age. On top of this, 84% of retirees only take their minimum RMD when mandated. Now, one can draw two conclusions from this. Number one, their RMD just happens to perfectly fit in their spending and tax picture, and that's why they only take the minimum. Or number two, a lot of people have what we refer to as an excess RMD, meaning they are forced to take out more than they want, and that's why they take the minimum. Number two, it seems a bit more likely to me, but who knows? The point is, it seems RMDs affect more people than just a few percent. So where does this leave us in the RMD debate? When we add it all up, yes, the last few years have brought some level of maybe marginal relief. The RMD formula became slightly more generous to some. The starting age got pushed back. Tax brackets have stayed lower for longer. All of this adds up to marginal improvements. Helpful, but in my opinion, small. But here's one clear counterpoint that overshadows all of these changes. The size of accounts has kind of exploded. If RMDs primarily affect the top decile of retirees, the wealthier households, that group's net worth has grown roughly 70% since, let's just kind of use that 2017 point. And that's not just theory. The stock market is up over 220% over that same stretch. Real estate has appreciated around 70%. So if you're sitting there in 2017 at age 60 thinking, I may have an RMD issue down the road, odds are that problem hasn't gone away. It's actually gotten bigger. Unless, of course, you've taken proactive steps to manage it. And that brings us full circle to the real issue with all of these grand statements floating around on YouTube. The idea that everyone should Roth convert everything is wrong. But so is the idea that no one needs to worry about RMDs and shouldn't Roth convert anything. Both of these extremes sound confident. They get a lot of clicks, but they don't build better retirement plans. The truth lives in between, and it lives in your personal numbers, not in a one-size-fits-all headline. Now, this brings us to the final point that hopefully wraps this all together. The premise that on a population level, we need to label RMDs as a problem or an overblown concern is just ludicrous. You can't place people into a bucket saying they should or shouldn't Roth convert based on account balances or by labeling whole groups. Tax planning in retirement is a very individual exercise. Let me show you what I mean. On the screen, I have an example couple. They're 65. They have $1 million in their traditional IRA. And besides for that, only Social Security. Now, many of those arguing against RMDs as a concern would argue that someone with only $1 million doesn't have to worry about RMDs. Yet, as we dive into this couple's tax graph, we can see those arguments are completely wrong. We are showing taxes owed on a real basis. And as you can see later in life, this tax graph just continues to climb. Why? Because excess RMDs are forcing them to withdraw more than they need, thus spiking their tax liabilities. We see other years where taxes are extremely low, which shows obvious opportunities for Roth conversions and flattening out their tax situation. Hopefully we can all agree this person has an RMD problem. It might not be the same problem as someone with 5 times the retirement savings, but problems are all relative. To fix some of this, we can see that nothing crazy is really needed. Something as simple as maxing out the 12% bracket is set to lead to some significant improvement. It's also incredibly unlikely this Roth conversion strategy would be at risk of hurting their situation, even in a bad scenario, because they are converting it at such low and acceptable rates. Next, we look at scenario number 2 of a 71-year-old single male who has $1 million IRA and both pension and Social Security assets. If we look at their tax graph, we see things are pretty flat overall, except for one spike in 2026 due to a one-time spending purchase that this person has. Now, as we dig deeper into the weeds, we see some really minor opportunities at most for small conversions, but overall, RMDs are not a big problem for this retiree. If you did a present value calculation of this person's pension, by all accounts, they have more in assets than the previous example, and yet they don't have the same RMD problem. If we try to fit in a general Roth conversion strategy, we see no real improvement. I show these 2 examples to drive home the point that broad statements in tax planning are often not helpful. RMD problems are not a population problem. They are an individual problem and should be treated and assessed as such. Now, before we wrap up, it's important to remember that RMDs aren't just about how much you have saved. There are a lot of other factors that determine whether you actually have an RMD problem. One of the biggest is withdrawal rate. If you have a relatively low spending rate compared to your assets, you're more likely to have excess RMDs later on in life. Pensions are another big one. Unlike the example that I showed earlier, most people with a solid pension will find that RMDs create excess income because their base expenses generally are already covered or mostly covered through that pension. Longevity also plays a huge role. The longer you live, the more years those RMDs have to compound, and the more pronounced that RMD creep becomes. And then there are things like charitable giving, investment allocations, and spending goals, all of which can completely change the tax picture, even for two retirees with the exact same account balances. That's why no YouTube video, mine included, can give you a blanket answer for your situation. If you're watching YouTube to try to get personal advice for your situation, you're looking in the wrong place. So when you hear someone say that RMDs don't matter anymore, or on the flip side that RMDs are the biggest threat to your retirement, remember this: most of those statements are designed to get views, not improve your plan. Yes, tax laws change, markets grow, and every plan is different. The real edge in retirement planning doesn't come from blanket statements. It comes from understanding your individual situation and coordinating all of the moving pieces correctly. If you'd like to see how RMDs fit into your plan or how to build a smarter tax strategy around them, you can reach out using the link or phone number in the description below. Always remember, you don't need more money, you need a better plan. I look forward to seeing you in the next video.